Thank you very much for taking the time to come and listen to me today. As Chi kindly said, I'm Ardal Loh Gronager, and I'm the managing partner of a hedge fund based out of London called Loh Gronager Partners. I appreciate, I think it's just afternoon for you. It's quite late evening for me here in London. So apologies for the lighting in the room. It's actually the first presentation that I'm going to be giving virtually. So that's the first for me. Usually I do these in person. So I hope one day to come and visit you at your university in Atlanta, Georgia. I usually start these presentations with just one takeaway from my time when I was at university. I went to university in the UK, and that was I would really encourage you to make the most of your time at university, especially when you're at such a prestigious one as you guys are. And I'm sure you get loads of opportunities to join societies, participate in events, and listen to speakers. And I would just encourage you to grasp all those opportunities while you can, as curiosity and learning are just really, really important, I think, to success overall in life, and also, as we'll touch on in my presentation, in investing. So I'm just going to see if I can share my screen with you here. So I'm just going to make sure, sorry, show of hands again, just to make sure you can see the presentation.
Yeah, we can see it. Thank you.
Okay, fantastic. It's interesting because obviously sometimes we have technical issues even in this day and age. So the title of my presentation is How Not to Construct an Outperforming Investment Portfolio. And that might seem like a bit of a strange title, but I'm hoping that this slide will illuminate the reason why a little bit more. I'm sure all of you in the room know that the gentleman on the right-hand side here with the blue tie is Warren Buffett, the world's most successful investor. And then next to him with the red tie is the slightly less well-known former business partner of his, the late Charlie Munger, who was the vice chairman of Berkshire Hathaway. And he was widely referred to as Warren's right-hand man. And he pioneered this mental model of what we call inversion. And it's actually a Stoic philosophy that was explored in the writings of the Roman Emperor Marcus Aurelius back in 120 to 180 AD. And he was a battlefield general. And he basically thought that rather than thinking about how to win a war, he thought, why not think about how not to lose it as a strategy? And what Charlie Munger said when it came to sort of modern investing was invert, always invert. Take a situation or problem upside down, look at it backwards. What happens if all of our plans go wrong? Instead of looking for success, make a list of how to fail instead, through sloth, envy, resentment, self-pity, entitlement, all the mental habits of self-defeat. Because if you avoid those qualities, you will succeed. And that's why my theme of my speeches is about the mental model of inversion here. So we're going to explore how not to do something. And we're going to learn via how not to do it, how we should therefore do it to maximum impact for ourselves. So as I said briefly at the introduction, my name is Ardal Loh Gronager, and I run a hedge fund here in London called Loh Gronager Partners. I'm the managing partner, so I'm responsible for all the investment decisions, and I run our global fund. A little bit of background about myself. I'm half Danish, but born in the UK. I was educated across Europe, Asia, and Australia. So when I was asked in school, tell me an interesting fact about yourself, my fact was always that I lived in 11 houses. I went to 8 schools in 7 countries. And then I ended up studying accounting and finance at Durham University in the UK. I've got over 10 years financial industry experience on both the buy side and the sell side. I started with internships at Goldman Sachs and Swiss Re Asset Management before moving to be an interest rates trader at Morgan Stanley. From there, I moved to be a credit trader at Credit Suisse. So as opposed to the macroeconomic side, which you would say is the interest rates trading, I moved to essentially invest on the microeconomic side as a credit trader. And from there, I moved to be the chief investment officer for a UK-based family office. And then from there, I set up my investment partnership that I run today. And it's about 4 years old. I'm also the author of a book called The Perceptive Investor. The Art, Science, and Temperament of Successful Value Investing. I published this book in conjunction with the Financial Times newspaper, and all of my author's proceeds are donated to charity to enable students to learn more about financial literacy and inclusion. When I do these talks, usually at universities, as I said, I do them in person, and to the best question at the end, after my short presentation, I usually give a signed copy of my book. This time it's a little bit harder, so at the end of the presentation, I'm just going to ask you if you could email me. If I select yours as the best question, I'll then send you a signed copy of my book. In terms of a little bit of background about my fund, we're an investment partnership that's based on the principles of the original Buffett partnerships. So one of the less well-known facts about Warren Buffett is the fact that he actually ran his own hedge fund before he founded or took over Berkshire Hathaway over 60 years ago now, in the 1950s. We are concentrated long-term value investors looking to partner with exceptional businesses. And by that, I mean that all of our portfolio businesses demonstrate several things in common, namely strong growth potential, widening economic moats, and being run by high integrity management that think like we do as business owners. This painting, I think, on the right-hand side demonstrates best. I often say a picture is worth 1,000 words. And this picture demonstrates what perception is and why my book is called The Perceptive Investor. What you can see there is the artist is pictured seated and he's looking at a stationary egg. But on the canvas in front of him, he's painting a fully grown bird in flight. And that's the power of perception. And in investing, it would mean looking at all of the publicly available information about a business and being to project forward a different outcome or conclusion about it. So I thought I'd give you a little overview of the hedge fund industry more broadly as of today before I do a deep dive into the presentation. You know, I'm often asked, what actually is a hedge fund? Well, you know, it encompasses an absolute plethora of strategies, but essentially it comes down to a very straightforward structure, which you can see on the bottom here. A group of investors pool their capital together and pass it to a hedge fund manager. That hedge fund manager invests it into a portfolio of stocks, bonds, options, FX, swaps, CDOs, anything you can possibly imagine. It usually means that it's liquid, which means it's publicly listed or actively traded. And he selects the portfolio to achieve a specified rate of return that he's targeting for those investors. In terms of the industry itself, it consists of about 10,000 funds globally, managing about $4 trillion of assets today. And increasingly, it's becoming more institutionalized, with about 1,800 funds managing over $1 billion. So that means that the average hedge fund manages less than 100 million. And in the circular diagram on the right-hand side there, you can see all the sort of, a selection of the strategies, everything from convertible arbitrage to macro to equity long short to what we do, which is equity long as concentrated value investors. So with that, I'm going to dive then into what I'm calling how not to construct an outperforming investment portfolio. So I've started here with a quote: "To finish first, you must first finish." It might be familiar to some of you. Juan Manuel Fangio was a 5-time Formula One world champion in the 1950s. And I myself am quite a fan of Formula One, which I know is gaining in popularity in the US, mainly because of the Netflix series. And essentially what he's saying there is very true, not only in racing, but also in investing. What we want to do is we want to make sure that our investment strategy and business strategy, of which there are two elements to building a successful hedge fund. One is the business strategy and the other is the investment strategy. We want to make sure that they are anti-fragile. And by that, I mean that to succeed, we have to have a successful business strategy that allows us to have a successful investment strategy. And in today's presentation, we're going to be focusing on the investment strategy, but they have a lot of similarities in common. When it comes to running or having a successful business strategy, you need a strong team. You know, your firm needs a strong balance sheet. And on the investment side, you also need your portfolio businesses to have strong management teams and also have strong balance sheets. So that's the anti-fragility requiring both. I think that many investors start by choosing the individual businesses or stocks that they want to buy before they decide what their portfolio should look like. And what I'm going to propose to you today, that's the wrong way round. You need to select the portfolio first and the individual stocks that go into it are what come next. And we want an investment strategy that's going to outperform over the long term so that we can take advantage of short-term market volatility. And the reason for that is that there's an advantage to be gained by extending out our investment time horizon, being more longer term in our thinking. And that's because, as we know from the media, we're all very focused on the day-to-day moves of the market, the second-by-second stock ticker price of any stock that we look at. And therefore, by extending out our investment time horizon, we have less competition. And that's one of the things we're going to cover today on our investment strategy. So the first rule, and there are 5 that I put together of how not to construct an outperforming investment portfolio. Rule number 1 is don't be a value investor. What do I mean by that? Well, to me, all investing is value investing. Everything else is speculation. And to delve a little bit deeper into that, what I mean is all investing requires thought and consideration in terms of we're trying to buy an asset, no matter what it is, for less than its intrinsic value, i.e. we believe it's going to be more than what we pay in the future. Everything else is speculation. And what is value investing? Well, there's lots of different versions of value investing, and they have changed over time. They started with Warren Buffett's teacher. His name was Benjamin Graham, and he's what known as traditional value investing. It was essentially buying assets for less than their realizable value. So the example they're given is buying dollar bills for 50 cents, or in another example would be buying a product for less than you knew that you could sell it for if you were in a forced sale. And then we combine that with what's known as traditional growth investing. And the founder of that, or the pioneer, was Phil Fisher. And he said, I'm not sure about buying cigar butts or nets, as Ben Graham would call them. I think we're better off purchasing a concentrated portfolio of companies with compelling growth prospects that you understand very well and hold them for a long time. And what I think is that Warren Buffett has essentially combined the 2 sides of that together in what I call modern value investing, where primarily we do want to purchase great companies, but at fair prices, and where feasible, in his case, to purchase the entire business. We want to run a concentrated portfolio that operates in a diverse range of sectors with the objective of holding them indefinitely. And we want to remain open to special situations and strategic investments. Rule number 2 is don't be a concentrated investor. Here on this slide, what I've said at the top is diversification is essential, but over-diversification is fatal. So what do I mean here? Well, concentrated investing means that the more right you are on any one position in your portfolio, the more wrong you can be on all the others and still triumph, as long as the investment that you make in that one business outperforms all the times that you were wrong. And that's the definition of what concentrated investing is. It's few bets, big bets, infrequent bets, only made when the odds are overwhelmingly in your favor. And this refers back to the previous rule of, don't be a value investor, because the only reason why we would concentrate a portfolio is because we believe that the positions within it are superior. And to identify those, we need to have a value investor's mindset. So this is also done in recognition of the fact that exceptional investment opportunities are only found very rarely. And when you do find an exceptional business, you really do need to back up the truck. And what the chart shows you on the right here is essentially the dispersion of returns over time, depending on how many stocks in your portfolio. So you can see here that if you have 250 stocks in portfolio, the yellow line, your dispersion of returns is very tight compared to the market. You're basically going to track the market because you own the majority of the positions in it. It's only, for example, with the green line there, with the 10-stock portfolio, you see the dispersion of returns is much wider. So therefore, you have the possibility of significant outperformance. But this only comes into effect if we're able to choose superior businesses. And that refers back to rule number 1. We need to be choosing businesses for less than their intrinsic value. The third rule is to not accept that you cannot time the market. This rule, I think, is quite interesting because what it does is it highlights to me how important being humble is as part of your overall investment process. We often talk about the wisdom of crowds, but during periods of market euphoria or market panic, that euphoria can turn into the madness of crowds. Investors tend to add when the markets are rising. And the higher markets go, the more bullish they tend to become. And on the flip side, they tend to reduce or sell when markets are falling. And the more the market falls, the more bearish they become. As a result, the average investor has a buy high and sell low mentality. And that's essentially going to guarantee that you're going to underperform the market over any significant period of time. And what the chart shows here is essentially dollar-weighted and index-weighted returns. So what you can see in the index there is from 1997 to 2017, over that period of 20 years, the return of the US NASDAQ index, which is the main tech stock index in the US. And during that period of time, it averaged a 9% annualized rate of return. But in blue, you can see the dollar-weighted return. So that's the return that investors actually made for themselves by investing in that index. So here, they're not even stock picking. All they have to do is buy and hold the index. But what you can see over that 20-year period is the average investor managed to lose 5% per year. That differential after 20 years is absolutely enormous. And what this shows is that exactly this, what we're talking about, is that the average investor is their own worst enemy. It's very, very hard to time the market. And to take this a step further, what we therefore conclude is that what matters is time in the market, not timing the market. If we look at that 20-year study and we look at all the different asset classes we could have invested in, which broadly here you can see in the diagram, everything from investing just in the energy sector all the way just through to Japanese equities and quite a few different things in between. The average of all the returns during that 20-year period of time was about 7%. But investors during that period of time managed to make about 3%. And that's less than what they would have made if they just bought 3-month treasury bills and rolled it for that entire period of time. So it really does show that investors, the majority of the time, get it wrong. So it's all about time in the market, a long investment time horizon versus timing the market. And rule number 4, don't have a long investment time horizon. So the way I like to describe this is 2 different sides to it. On the left-hand side here, I say patience is a requirement for a successful investment strategy. So what you can see here is essentially the number of years it takes for a business, given a certain rate of compounding, or you could call this a stock price, with a given rate of compounding, the number of years it would take for it to 100 times your money. And even today, I'm quite surprised at how long it takes. So if you find a business that compounds at 25% per year, you would still need to own that investment or that business for 21 years to make 100 times your money. It's a staggering amount of time, given the average holding period for a stock in the stock market today is well under 1 year. And I think this refers quite well back to point 4, or rule number 4 there, which is we said, it's all about time in the market versus timing the market. So if we take that as a given that we need to have patience in our investment process, we also need to have patience in terms of the management teams of the portfolio businesses within which we invest. So here, what I've actually taken is a couple of paragraphs from Jeff Bezos's, and he's the founder of Amazon's letter to shareholders from 2007, because he thinks very long-term as a business owner and manager. He says at the bottom here, at Amazon, we like things to work in 5 to 7 years. We're willing to plant seeds to let them grow, and we're very stubborn. We say we are stubborn on the vision and flexible on the details. Jeff Bezos is exactly the kind of business manager that we are looking for as long-term concentrated value investors, as the steward of our capital in his business. He's also trying to think very long-term. And finally, don't try to identify exceptional businesses. I said in rule number 1 that, if we're not going to be a value investor, it might be very hard to find exceptional businesses, because what we're really trying to find here are the winners. As I said there, that, if we want to make 100 times our money within 25 years, the stock has to compound at 20% annualized. But if you sold the stock after 20 years instead of after 25 years, you'd actually only make 40 times your money. And what that shows you is that the majority of the gains of holding the stock come at the end of the investment holding period. You have to allow the magic of compounding to work. And therefore, we really need to be looking for outlier businesses. And that's essentially what this graph here shows at the bottom. What it shows you is that the median return for owning a stock in the stock market is actually negative. The average business in the stock market is not a good business. But the reason why the average return of the stock market over time is positive is because there is this large tail of outlier positive return businesses. And it's those extreme winners that drag up the entire average of the index into positive territory over time. And it's those businesses that we are trying to identify. And I put it to you that the correct method of being able to do that is through value investing. So to summarize about how not to construct an outperforming investment portfolio, I'd say rule number one, don't be a value investor. Rule number two, don't be a concentrated investor. Rule number three, don't accept that you cannot time the market. Rule number four, don't have a long-term investment time horizon. And rule number five, don't try to identify an exceptional business. And I thought I would end by just explaining to you briefly how I do it at my investment fund. In terms of portfolio construction, I think concentrating your portfolio over time is what's going to give you the exceptional long-term performance of a really great investor like Mr. Buffett or Mr. Munger. But at the same time, we do need enough diversification. So as Manuel Fangio said at the beginning of the presentation, to finish first, we must first finish. So essentially by that, we diversify our portfolio by geography, by sector, and by business model. And we also diversify in terms of the types of positions we have. So we have what are called full positions, which are roughly 5% of AUM, or our assets under management, and watch list positions, which are 1% of our AUM or 1% of our assets under management. And we split the portfolio between developed markets and emerging markets. And we have roughly 30 holdings across both, so 15 in developed markets and 15 in emerging markets. And we think that that gives us good diversification by geography. In our portfolio, we have exposure to 14 different countries within 30 holdings. We have good sector diversification. No one sector in our portfolio takes up more than, say, a third of our fund. We have business model diversification. We want to try and make sure that each of the businesses within our portfolio are all different. And then finally, we operate a rebalancing strategy between the emerging markets and developed market strategies over time, because we believe that all of our ideas in our portfolio are our highest conviction ideas. But what we need to do is to allow the market to tell us which ideas we're right on and which we're wrong on. And that's why we allow our winners to run. So when a business does well in our portfolio, we allow it to compound over time. And if a business over a 5-year investment time horizon doesn't perform well for us, but the thesis behind it is still correct, that's usually where we admit that we were wrong. And that's part of being humble in your investment process. And I hope that what this overview has given you today has explained to you that temperament, i.e. patience, is what's really essential when it comes to constructing an outperforming investment portfolio. And with that, I'll just say thank you once again for your time today, and I'm very happy to answer any questions that you might have.
All right, so hi, thank you so much for your presentation. It was really informative. I'm Ricky, I'm the Vice President. I'm going to be kind of your man on the ground for the Q&A that we're going to be holding. So I guess we can open it up to questions, and then there's also a bit of a question bank that we've kind of gathered from some things that some students want to hear. So does anyone have any questions? Okay, go for it.
Hi, thank you. My name is Jordan. I was wondering if you could expand more on your experience in buy side and sell side before you started your own hedge fund.
Sure, thank you for the question. I think I might just throw one question back to you first, because it might help me to frame an answer for you, which is, are you more interested on the buy side or the sell side? Or is it more in terms of the knowledge base you'd like to know, which would help you with either one?
The second option, to help me decide between either one.
Interesting. So I think there are advantages to both. And I think that my initial advice would immediately be maybe not to be too fixated on one or the other. I think that both offer really interesting learning opportunities. And there's an opportunity also during your career to move between the two. For me, it just so happened that I ended up on the buy side after spending time on the sell side. The sell side is, I'd say, a little bit more commercial. So you're working at, in general, the investment banks. And I actually don't think that there are very few places that are as good to learn as an investment bank because the breadth of different sectors, the breadth of client base that they have interaction with, in general, they have interaction with everybody else on the buy side. So that way, it gives you a really good exposure to everything and all aspects of finance. So it's one of the reasons why I started my career with internships at the investment banks, because I thought that that was a really good way for me to try and figure out where my interests really lay. I did also do an internship with Swiss Re Asset Management. So that was on the buy side. They have a portfolio management team that essentially helps them to manage their portfolio of fixed income, which I also found very insightful. The only thing I found was that the breadth of exposure I had on the sell side was much more than I would have had on the buy side. So that's the reason why I started there. And I started in sales and trading at Goldman Sachs. And then, as I said, as an interest rates trader at Morgan Stanley, so that was the macroeconomic side of the business. I was trading interest rates for Portugal, Ireland, Greece, Cyprus, and Slovenia during the European sovereign debt crisis. So that was really for me to learn the macroeconomic side of investing. And then from there, I've, for me personally, what I wanted to learn was the macroeconomic side and the microeconomic side. So that's why I then took the offer to move to Credit Suisse to learn the microeconomic side of the business. So there I was trading the debt of banks. So I was essentially working with a team of analysts looking at the income statement, balance sheet, and cash flow statements of banks and working out where within that capital structure it would be best to deploy our own capital at the bank, but also recommend to our clients to invest in. And those clients were all buy-side clients. And then from there, I moved to work at a family office, which, it was interesting to then sit on the other side of the table and interact with the sell side. And I think you realize quite quickly that, there are advantages to both roles. I think from my personal experience, it was the breadth of opportunity on the sell side was really important to me. And then once I figured out the area of investing that I wanted to go into, finding a specific buy-side institution that focused on that was the perfect place for me. I hope that sheds a little bit of light for you on that question.
It does. Thank you very much for your thorough answer.
Anyone else have a question? Yeah, go for it.
Thanks. My name's Victor Alvarez. Again, thank you for the presentation. Thoroughly enjoyed it. I noticed a couple of times you used the term realizable value, which I thought was very interesting because typically you hear people say that, when referring to the same thing, they call it intrinsic value. And I was wondering if there was purpose to that. Do you think that it's possible for the intrinsic value of an investment to never be realized? And is that a problem, would you say?
I think it's really interesting that you picked up that terminology that I use there. So traditionally, as you rightly say there, we talk about an asset trading at a discount to its intrinsic value. That's the textbook Benjamin Graham net cigar butt investing. That's where that terminology comes from. Whereas for me, what I think when I talk about realizable value, I actually talk about essentially the price that we're going to sell it at in the future. And I think that they are different, intrinsic value and realizable value. I think it's very possible that many businesses never ultimately end up at their realizable value and their intrinsic value matching at the same point. I think often we buy and sell assets when we think they're approximating their intrinsic value, but actually what we don't understand about them is their realizable value. So an example would be when you own a stock and it goes up 10 times and you therefore look at it and you go, it's reached what I believe that the discount to intrinsic value has decreased substantially from when I originally invested. And that's without looking a little bit deeper, realizing that as value investors, we don't care about the share price. What we care about are the fundamentals underlying the business. So if the fundamentals underlying the business have continued to improve, then I would argue that business that is 10x could potentially have significant additional value from where it is. And therefore, we need to focus on that realizable value further out into the future. And that's my interpretation of it. Thank you for your question.
Elaine, thank you so much for your presentation. I was wondering if you could talk more about like the process of making your own firm. And I'm sure it wasn't easy, like kind of transferring from a bigger company to managing your own hedge fund.
Sorry, I only got the first half of that question. It's possible just to repeat it for me?
Yeah, so she was asking about kind of the process of transferring from working for somebody for kind of working for yourself and starting up your own firm, and kind of what the challenges were and kind of what you got out of that experience.
Absolutely. A great question. So when I was, where you are now, which is at university, I treated everything like a learning experience. And that's just what I was encouraging you to do at the start, which is, any talks, anything that you're interested in, really do follow your curiosities. And I wasn't entirely sure what area of investing when I was at university, or what area of finance, or what area of markets was the one that I wanted to spend my career in. And that's why I didn't want to limit myself at the beginning. And that's really why I went to the sell side, because as in the answer to the first question, they had the broadest plethora of different paths that I could go down and sort of explore. The one thing I did know was that I always wanted to run my own fund. I didn't know what my fund was going to do. So I didn't know whether I was going to be a great macro investor. I didn't know whether I was going to be specializing like I do today in equities, or whether it was going to be foreign exchange trading. I didn't know. But what I did know is that I wanted to try lots of different things and find out what I was good at. And I guess for me, I came to investing second and entrepreneurship first. So I started my first business when I was 8 years old in a school playground. You guys might not remember it. It makes me feel a bit old, but the Nintendo 64 was the main games console when I was really young. And the games console was really expensive, and the games were really expensive too. So often, you'd have the games console, but you'd only have one or two games. So my idea when I was in the school playground was we'd start trading these games in the school playground. And that's how I made my first sort of sum of money at the age of 8. And then from there, I just moved to doing other entrepreneurial pursuits. So one example was we moved via Hong Kong to Sydney in Australia when I was 11 years old. And I started an import-export business between Hong Kong and Sydney. And what I was doing is I was essentially buying small electronics products and then selling them on eBay for a profit. And that was another business that I started. So I was always entrepreneurial before I came to investing. And I only came to investing because I essentially had accumulated quite a lot of savings in my account. And my dad took me to one side and basically said, son, this money can work for you and it can earn you more money while you sleep. And I thought that was a really interesting idea, because at the time I was doing a dog walking business and a newspaper round and all sorts of other things. And there's only so many hours in the day that you can do that work and earn that money. So I thought, wow, what a great idea if, I can put this money to work and it's going to earn more money for me. And that's essentially where I came to investing, which was, it was a way for me to deploy my capital to earn the greatest rate of return. But also for me, because I worked so hard to earn that money, I didn't want to risk it all going to zero. And I think that's why value investing became very naturally to me, which was I wanted to try and find things that were secure, but could also offer me a strong rate of return. And then, when it came to, essentially transitioning from a stable career, earning a salary, working at a financial institution, and then starting my own fund, to some people that seemed incredibly risky, but to me, it didn't seem risky at all. Because for me, I had the confidence of the fact that I knew what I was doing, which some might say is more folly than reality, but that's okay, because all entrepreneurs have to be optimists, and the future belongs to the optimists. And the second stage was I just thought, at the age of 31, if I'm not going to do it now, I'm never going to do it. So I think, in life, we have to take risks. And if you find your passion, then there is nothing great to be found in thinking small. You should be thinking big and really trying to follow your passions. And on the flip side of it, I looked at it the other way and I thought, well, the worst thing that happens is I have an experience, it doesn't work out, and then I will go back and find another employer. Thank you for your question.
Okay, go for it.
Yeah. Hi, thanks for the presentation. So I'm just curious, so like in your portfolio, you're at the full position, the watch list position. So like on what conditions do you think like you have like accumulated enough returns on the full, or you're thinking like your holding like no longer works out that you have to sell them?
It's a good question. So in the portfolio itself, the differentiation between a full and a watch list position is because I've learned a few things about myself and my investing style over time, which I think, you will all recognize when you start investing for yourselves if you haven't already over time, and you'll notice patterns. So one of the patterns I noticed was that I seemed to be quite good at identifying what, in hindsight, were exceptional businesses. And then I had this magnificent art of not buying them. So the reason why I didn't buy them was because I thought they were too expensive. So coming back to the question earlier about discounts to intrinsic value, I thought that they weren't trading at a great enough discount to their intrinsic value. So I never bought them and put them in my portfolio. Those businesses, that's what's known as an error of omission. So it's an error because I didn't include it in my portfolio. And because of that, I now have a rule, which is if I find an exceptional business that I think is one of the best businesses in the world, it doesn't matter to a degree what the current valuation is. I make it a watch list or 1% position in my portfolio. And that's because I've learned over time that those watch list positions tend to be the best performers. Because for us to estimate what the intrinsic value of a business is really, really hard, because businesses change year over year as the world changes around them. So that's the genesis of why we have full positions and watch list positions. And then in terms of how far we allow a position to concentrate, we have one position in my fund today that's 20% of our whole fund. And that position didn't actually start as a 4 or 5% position. It actually started as a watch list position 3 years ago. So that's an example of a business that's gone up 20 times in value, which kind of comes back to my point, which is sometimes I think you have to adapt your investment process and your portfolio management strategy to your own strengths and weaknesses. Old me would not have had a position in that business. But within my fund, I do, because I recognize my own shortcomings previously as an investor. So in general, we allow a single position to concentrate to 25% as a maximum within the portfolio before we would cut it back. But it wouldn't be unusual for me that the top 3 to 5 positions in my fund would be half of my fund. Because I really do believe that it's only a few businesses, coming back to that diagram I showed for rule number 5, it's very, very few businesses that provide all of the positive returns in the market. So if you have one of those in your portfolio, you really need to allow it to run. And that's where you're going to generate outsized returns. Thank you for the question.
Oh.
Hi, I'm Sherry. Can you hear me?
Yes,
Okay.
I can hear you. No problem.
I saw that you took on the trading role, at Morgan Stanley, and I wonder how did you make the decision to try trading, and why didn't it work out in the end?
So during my internships, essentially, there were 3 different routes to go down within investment banking, broadly speaking. So there's the asset management side, which would include wealth management. Then there's the investment banking side. So that's like mergers and acquisitions for companies. And then the other route is sales and trading. So sales and trading was the route that I went down. And that's obviously the heart and soul of what I believe, financial markets are. And at Morgan Stanley, the internship allowed you to experience working with salespeople and also with traders. And what I found from my experience was that the best salespeople were also the best traders. And the best traders were also the best salespeople. Because what you work out is you have to work as part of a team. The sales team and the trading teams, they sit almost back to back with each other on the trading floors. So it's really the skill set required to be exceptional means that you have to be good at both. And I kind of tie that in with the question from the lady behind you that she asked earlier, which was, in terms of running your own business, your own fund management business, I don't think you can run a good fund management business by just being a great businessman or just being a great investor. You need to be able to do both. So you need to be an entrepreneur. You need to be able to talk about your business. You need to be able to meet people. You need to be able to market your fund. And then the flip side of that, you need to have a great investment process, investment strategy to outperform. But if you don't have a great business strategy, it doesn't matter how good your investment strategy is, because your business won't be around long enough for anyone to work out how good you are. And that's why I sort of skimmed over it in the presentation, but the average life cycle for a hedge fund is only 4 years. So we're now in at the end of our third year for our fund. So on average, we would only have 1 year left. And the reason why the turnover in the hedge fund industry is so high is because I think that a lot of people don't understand that to run a hedge fund means to run a business. So they think that just because I'm a good investor, I can run a fund of other people's money. But the truth is you have to be able to run a business to run other people's money. And if you can't do that, it doesn't matter how good your returns are, because your business won't be around long enough for those investors to receive those returns. So I hope that sheds a little bit of light there on that question.
Thank you so much.
Hi, my name is Dylan. Thank you so much for speaking with us. I'm curious about the idea generation process. So, do a lot of your ideas from when you're investing kind of come from colleagues, from when you were on the sell side or different firms, or is that, how do you guys find new companies, or is it all done internally, or what does that process and collaboration really look like within the firm and with others on the street?
It's an interesting question. So I think that your investment process needs to evolve over time. So a little bit like how I addressed your colleague's question earlier about the portfolio between watchlist and full positions, that evolved from my own experiences investing in markets. I think how you source investment ideas can also change over time. For someone that's not particularly familiar with investing in the stock market, my advice normally is look at the things that you use on a day-to-day basis and just explore whether any of those are publicly listed businesses. I often just say, make a list. Do you own an Apple computer or is it an HP? And then I'd have a look at those publicly listed companies. Do you have a subscription to Netflix? That would be another publicly listed business. And the reason being why is because those businesses probably sit within your circle of competence. Because if I ask you, why do you own an Apple laptop? Or if I ask you, why do you have an iPhone? Or why do you subscribe to Netflix? You'll have reasons why. And it'll be because you think the iPhone is the best phone in the world. Or it will be because you think Netflix is great value for money. So you can almost identify the moat around those businesses because you're a consumer of them. So they would sit within what I call your circle of competence, i.e., those are businesses that you can identify that might be exceptional. Now, the question is, are they good value today at the current price relative to what we believe their future value or intrinsic value is? And that's a more subjective question. But to identify businesses that sit within your circle of competence that you could put in your portfolio, that's a good place to start. For us at my firm, we do it in quite a few different ways. So we screen the entire universe of investable security through about 45,000 listed equities around the world. And we screen them in lots of different ways. So we can screen them on what I call quantitative metrics. So that would be, does the business trade at a low price to earnings ratio? Does it have a high return on capital employed? I.e., is it making a lot of money on the money that it has invested in the business? Does the business have good margins? So, is it able to produce a product at one price and sell it for significantly more? Another way of screening is qualitatively. So do we think that the management team of the business we're looking at are good capital allocators? Do they create value over time? That's another way. Warren Buffett famously used to identify businesses with a method that he called starting with the A's. And that basically meant he went through all the businesses in the index listed alphabetically A through Z to work out what businesses that he wanted to learn a little bit more about. I think in today's day and age, we can use technology to be a little bit faster than that. Another is, I would suggest, is you could look at the investment portfolios of other exceptional investors. So online, you could find quite a few different websites where they compile the portfolios that are publicly known of many famous investors. And you can look at their holdings and you can try and reverse engineer why they might own those businesses. Another one that comes to mind is, reading the newspapers, trading the industry journals, attending investor forums or conferences, and seeing what ideas pique your own interest. You'll notice out of all the examples I've given there, I didn't once mention sell-side research. And that is because we don't use sell-side research at all in my firm. We generate all of our own research internally. And I think the key reason to remember there why we might do that, from my perspective, is that sell-side research is generated for one thing and one thing only, and that is to make you buy or sell, because the people producing that research only get paid if you buy or sell. And that's also why, I also say treat the media with a little bit of skepticism. Newspapers and the media are designed to attract eyeballs. They make money through advertising. The more headline grabbing the title, the more cataclysmic end of the world the article comes across, the more likely you are to click on it and to read it. And therefore, they're more likely to generate more advertising revenue. So I always treat what the media says also with a degree of skepticism. But I hope that through all of those different methods, there might be some there that align with you in terms of how you might go about selecting your own investments.
I'm Victor again, and I had another question. There have been numerous explicit references to sort of Graham Dottsville and a lot of that school of thought in your presentation. You talked about the circle of competence, margin of safety, and the previous question that I asked. There was another that I thought was a little interesting, maybe a little more subtle. I might be making it up, but the title of your book is The Perceptive Investor. I was wondering if it's a coincidence that that's much alike The Intelligent Investor written by Graham. And if so, do you think that there's a difference between perception and intelligence, and especially when it comes to the role they play in investing?
I'm going to say it was perceptive of you to realize that the titles were similar. So the title is sort of an homage to Graham, who is essentially the father of value investing, and his book, The Intelligent Investor, which arguably is the foundation on which all modern value investing is built, as Warren Buffett himself would say. I think all investing, as I said in the presentation, is value investing, right? And by that, all investing is intelligent investing, because it means that it requires thought. Everything else is just speculation. If you are buying a stock because it's gone up and you've done no research, you're speculating, you're gambling. If you go to the horse racing track, you're speculating, you're gambling. Again, it's not a degree of intent. If you go to a casino, the house has an edge over you. Obviously you could card count, which technically you're not allowed to do. But broadly speaking, if you go to a casino, you're going to come out with less money than you went in with. So a degree of intelligence is required to separate investing from speculating. And I think that's what Graham was arguing there. And his view of intelligent investing, which you mentioned there in your question, which is discount to intrinsic value. For him, it was net nets. For him, it was businesses that were trading below their liquidation value, i.e., in those days, most businesses were very heavy in terms of plant, machinery, and capital they might have. So an example would be he might buy a company that was a warehouse company, and let's say it was a warehouse company that had warehouses full of steel that they owned. He would go to the warehouse, add up the value of all the steel, work out the number of shares in the business, and divide the value across all the number of shares. And he might realize that per share, the warehouses contain $10 worth of steel, but the share price was $5. So he would therefore go and buy the shares of the steel of the warehousing company in the market for $5, knowing that if he ended up buying that business or the business went into liquidation, he could sell all of the steel and make $10. So he was going to double his money over time. That is in essence what a net or 50 cent dollar bill investing is. For me, perceptive investing is a bit of an evolution from there. Today, a lot of businesses, their value is in intangibles. So as opposed to tangibles, which would be the example there of a warehouse full of steel, today, a lot of businesses' value is in intangibles. So an example of that would be Coca-Cola. Coca-Cola's trademark is an intangible asset. You can't touch it, but it clearly has value. I would argue you can go to anywhere on the entire planet and say the word Coca-Cola, and people will know what you're talking about. That clearly has an enormous amount of value. The sort of 100-year history of Coke and their marketing that essentially means that we all associate Coca-Cola with good times, whether it's the Olympics or whether it's Christmas, all the adverts, everything to do with Coca-Cola. But that's intrinsic. You can't touch it. And therefore, I think that today what we require is a little bit of perception when it comes to evaluating future businesses and their values, because it requires us to think a lot more about what's the future worth of the business versus what's the current worth relative to its assets. And I think that's the evolution of value investing over time as we move more and more towards the intangibly led businesses. For example, Netflix, the value of Netflix is all in the IP, which is the library of content that they have. But again, it's not tangible. You can't touch that. They don't have, thousands of office blocks all around the world that we could value and liquidate and have a realizable value from them. So that for me is why I believe that what we're doing today is perceptive investing. We're trying to look at all the available information about a business and project forward its future valuation.
Thank you.
Do we have any more questions? Okay, so I think we're in a good place to wrap things up. So thank you so much for your time and for coming down and talking to us and sharing your insights over your career. It's been a pleasure to have you.
Really appreciate your time. Thank you very much.